Under capital gains, now comprehensive problems. Let we see practice 1. Compute taxable capital gain from the following information. Cost of acquisition of house property. First of all, we must note which asset was sold, whether it is capital asset or not. We have to consider that one. Here, house property was sold in August 2000. Purchased in August 2003 for rupees 2,50,000. Registration fee and other document charges 50,000. So the total cost of asset will be 3 lakh. Brokerage paid on purchases will be another 20. So totally 3,20,000 will be the entire cost. This property sold in December 2021 for rupees 38,50,000. Commission paid on sales 50,000. Amount invested in another house property. So it is a transfer of house property. No information about the commercial. So let we assume that this one for residential purpose only. So it is a transfer of residential house property. So we can claim exemption under section 54. Let me see the answer. Sale proceeds 38,50,000 less expenses on sales 50,000. Balance is called net consideration less indexed cost. In the year 2003 to 4 we purchased for rupees 3,20,000. In that year index is 109. We have to convert for the current year index for the 317. The indexed cost will be, it is rounded off 2 rupees nearest to 10. 9,30,640. Balance is long-term capital gain. Here less exemption under section 54. Transfer of residential house property. Actual investment in the new property 15 lakh and the long-term capital gain 28,69,360. Out of these two, whichever is the least exempted, balance only taxable long-term capital gain. It is a comprehensive problem only related with the exemption under section 54. Some additional information of the registration fee and other document charges, brokerage paid on purchases and the commission paid on sales that were included. In the same pattern, the students can practice exercise 1 and check the answers. Now, practice 2. Compute taxable capital gain from the following information. Cost of acquisition of residential property in July 2002, 10,50,000. Expenses on its registration, 1,50,000. Sold that property in December 2021 for 82 lakh. Commission paid on sales 2 lakh. Amount invested in another residential house property, so we can claim exemption under section 54. Amount invested in the bonds of NHA, so we can claim exemption under section 54 EC. Investment in equity shares. Actually, this is a residential house property. By selling the residential house property, what's the amount received? If any part of that sale proceeds invested in some listed shares, we can also claim exemption under section 54 GB. So in this problem, we can claim exemption under section 54, 54 EC and 54 G. Let we start the answer. Right. Watch me. So house property sale proceeds 82 lakh, less expenses on sales 2 lakh, balance 80 lakhs is the net consideration, less indexed cost of acquisition. In the year 2002 to 3, it was purchased for rupees 12 lakh. During that year, index is 105, so we have to convert the amount 12 lakh for our current index 317. The indexed cost will be 36 lakh 22,860. Let's first we can claim exemption under section 54. Transfer of residential house property. Actual investment in the new property 15 lakh or the long-term capital gain, whichever is least. So 15 lakhs is exempted. Less exemption under section 54 EC. Amount invested in the bonds of National Highway Authority. Actual investment or long-term capital gain, whichever is least. So we can claim 10 lakhs. Less exemption under section 54 GB. Amount invested in the shares of ACC Limited. So the amount of exemption will be actual investment into long-term capital gain by net proceeds. By applying this, we can get the exemption of 6,56,570. So balance 12,25,770 will be the taxable long-term capital gain. In the same pattern, the listeners can practice exercise 2 and check up the answers. Now let me go for practice 3. From the following information, compute taxable capital gain. Land acquired on September 2000. So land, in this problem, the capital asset is land. First of all, we must keep in mind which capital asset we sold during the current year. In the past, the previous two problems related with the residential house property. The third problem related with the land. Sold in August 21 for rupees 38,50,000. Commission paid on sales 50,000. Amount invested in another land. So we can claim it is a transfer of agricultural land. So we can claim exemption under section 54B. Next, invest in the bonds of Indian Railway. Amount invested in the bonds of IRFC. So we can claim 54 EC. Amount invested in residential property buys selling land, that sale proceeds invested in the residential house property, means we can claim exemption under section 54F. So in this problem, we can claim exemption under section 54B, 54EC, and 54F. Let's watch the answer. Asset capital is land. Sale proceeds 38,50,000, less expenses on sales 50,000. So balance net consideration is 38 lakh, less indexed cost. This land was acquired during 2005 to 6 of the index of 117. So we have to convert that cost 6 lakh into the current index for 317. The indexed cost will be 16,25,640. First, less exemption under section 54B. Actual investment in the new land 8 lakh, or long-term capital gain 21,74,360, whichever is least 8 lakh is exempted. Next, less exemption under section 54EC. Amount invested in the bonds of IRFC. Actual investment 5 lakh, but the capital gain is 13,74,360, whichever is least 5 lakh is exempted. Next, exemption under section 54F. Amount invested in residential property. The amount of exemption will be actual investment into long-term capital gain by net proceeds. Here the balance long-term capital gain is 8,74,000, but we applied the 21,74,360 for the benefit of the assessee. To get the maximum benefit of the assessee, this amount only be utilized when claiming exemption under section 54F. So balance 1,87,720 will be taxable long-term capital gain. In the same pattern, the listeners can practice exercise 3 and check it up the answers. Now let me go for practice 4. In this problem, 2 capital assets. One is house property and other one is jewelry. So cost, date of acquisition, sale price, expense and given. The amount invest in a new residential house property. In this problem, 2 capital assets. One is house property and other one is jewelry. So by sale proceeds of house property, the amount invested in another house property. So we can claim exemption under section 54. And the second capital asset is jewelry. By sale of jewelry, and the sale proceeds was invested in the new house property. So we can claim 54F. So in this problem, we can claim 2 exemptions. Exemption under section 54 and as well as 54F. Let's watch this. Cost inflation index for the year 2001 to 2 is 100, 2004 to 5 is 113, and 21-22 is 317. This cost inflation index will be given in the problem itself. Fair market value of jewelry as on 1/4/2001 is 15 lakh, because the jewelry purchased in December 90, so that jewelry's fair market value as on 1/4/2001 was given. So we have to consider actual cost before 1/4/2001 or fair market value as on 1/4/2001, whichever is higher will be considered while computing indexed cost of acquisition for jewelry. Let me start the answer. Sale proceeds 28,50,000, 75 lakh, less expenses on sales. Balance is a net concession, less indexed cost. For the house property, indexed cost will be 18,23,450, and for jewelry 47,55,000. Balance is long-term capital gain. Actually, these 2 capital assets were sold and the entire amount was invested in new residential house property. First, in case of house property, we can claim exemption as a section 54, transfer of house property. Amount of exemption equal to long-term capital gain or actual investment 40 lakh, whichever is higher. So that 40 lakhs is limited to only 9,77,550. So the balance taxable long-term capital gain for the house property will be 0. So the balance out of 40 lakhs, 977,550 only we applied for when claiming exemption under section 54. So balance 30 lakh 22,450 we can apply when claiming exemption under section 54F with jewelry. Okay, here exemption under section 54F, investment in new house property, long-term capital gain into investment, balance investment by net consideration. So we applied here the balance amount of investment. Okay, so the taxable long-term capital gain will be 15,27,890. In the same pattern, the listeners can practice exercise 4 and check it up the answers. Now practice 5. Mr. Khan purchased 500 equity shares of ABC Limited on 1/6/2010. Cost inflation index is 167 for rupees 270 per share. and income expenditure of 5,000 as brokerage. On 1st July 2012, he gets a 200 bonus shares. Bonus shares means additional number of shares granted by the company at free of cost. So for the bonus shares, no cost of acquisition. So cost of acquisition always be considered as zero for bonus shares. On 1st September 2014, he gets a 300 rights issue for 160 per share. Rights issue means additional number of shares be granted to the existing shareholders at a reduced price. But the rights shares has a cost value. So we can apply the indexed cost. On 28 to 2022, he sold all his 1,000 shares. Original 1,000 shares and the 200 bonus shares and the 300 right shares. The entire 1,000 shares sold for 620 per share and the incurs an expenditure of 12,500 on brokerage. Compute taxable capital gain. So computation of taxable capital gain for 1,000 shares. We'll see. Actually, we've shown here 3 breakup. 500 original shares, 200 bonus shares and the 300 rights issue. Sale proceeds. So 5 is to 2 is to 3. 5 is to 2 is to 3. The total amount 1,000 shares into 620. So 6,20,000 was shared in the ratio of 5 is to 2 is to 3. Let's brokerage paid on sales 12,500. So entire 12,500 was also apportioned in the base of 5 is to 2 is to 3. So balance amount is net consideration. Let's index the cost for the original 500 shares purchased at rupees 270 per share. So 500 into 270 plus 5,000 as a brokerage. So totally 1,40,000. This 1,40,000 was indexed with the current year index. So the indexed cost of acquisition will be 2,65,750. For the bonus shares, no cost base. Cost base will be zero. For the rights issue, same indexation was applied. So balance amount is taxable long-term capital gain. In the same pattern, the listeners can practice exercise 5. Now let we see practice 6. Mr. Murugan converts his plot of land purchased in July 2006 for 8 lakh into stock in trade on 31st August 2016. The fair market value as on 31st August 2016 was 19 lakh. The stock in trade was sold for 24,50,000 in the month of January 22. Calculate taxable capital gain and income from business. Here it is a stock conversion. Actually, first he purchased the plot of land and later on that plot of land was splitted and it was used as a business units. So we have to practice this problem very carefully. That stock conversion, sale proceeds 19 lakhs because the fair market value is on 31st August. The date of conversion is 19 lakh. That value will be considered. Let's index the cost. Actually, the plot was purchased in the July 2006. So for their 2006 to 7 index is 122, but it was converted on the year 1617. So for the 1617 for 264, the indexed cost will be 17,31,150. So balance is taxable long-term capital gain. Now in this year, the sales value of plot is 24,50,000 and the fair market value is 19 lakhs. So the balance 5,50,000 be treated as a business income, not under capital gain. In the same pattern, the listeners can practice exercise 6. Now, practice 7. Mrs. Radha purchased a residential property in Chennai on 10th May 2009 for Rs 3 lakh. On August 12, she entered an agreement to sell the house to Mr. Raman for 20 lakh and received 5 lakh as an advance. And Raman assured to settle the balance money within 60 days, but Raman was not able to honor the agreement and Mrs. Radha forfeited the advance money of rupees 5 lakh. This advance money of 5 lakh is an important fact in this problem. Mrs. Radha subsequently sold the property to Mr. Singh in 20th January 2022 for 35 lakh during our previous year. The amount invested in another house property, it is one residential property sold and that amount was invested in another house property, so we can claim exemption under section 54, but 4 lakh is deposited in the capital gain deposit scheme. So totally 20 lakhs was deposited in the new residential house property. The question is, what about the advance money? What will be the tax treatment? Let me see the answer. House property, sale proceeds 35 lakh, expenses on sales nothing. So let's index the cost. It was acquired in the year 2009 9 to 10. The index is 148. The cost is 3 lakh, but the current index is 317. The index cost will be 6 lakh 42,570. Balance long-term capital gain. Less exemption section 54. Transfer of residential house property. The amount invested in the new house property totally 20 lakh. Long-term capital gain 28 lakh 57. Whichever is leased, 20 lakh is leased. Balance 8 lakh 57,430 is taxable long-term capital gain. Note, advance forfeited by Mrs. Radha rupees 5 lakh from Roman be taxable under income from other sources but not under capital gain. In the same pattern, the listeners can practice exercise 7 and check it up the answer. Now let me go for practice 8. During the year ended 31st March 2022, David sold the following assets. Actually, in this problem, 4 capital assets are given one by one. First, the shop. It is capital asset. Purchased in 2005 to 6 for rupees 30,000 and sold for rupees 2,40,000. So index is 117 during the year 5 to 6. So for the first answer, let me start the answer. Commercial shop sale proceeds 2,40,000, less expenses 0, balance net concession, less index cost 2005 to 6. Index is 117 at the cost of 30,000. What will be the index cost for our year? With the index of 317, it will be 81,280. So balance 158,720 was taxable long-term capital gain for commercial shop. Because for the commercial shop, we cannot claim any exemption under section 54. And the second is land. Land in Agra, purchased in December 96 for 10,000 before 1/4/2001. So the fair market value as 1/4/2001 is 25,000. So 10 or 20, whichever is higher, 25,000. Index will be considered as 100. So second property is land, sale proceeds. Less index cost of acquisition, it will be 79,250. So balance 70,750 will be the taxable long-term capital gain for land. Next, the third one, household furniture. Household furniture will not be a capital asset under section 2, subsection 14. So any household furniture items sold, that asset was excluded from capital asset. So ignore that one. Household furniture excluded from capital assets, so taxable capital gain will be nil. Fourth one is machinery or plant. This one is a business owned property acquired in 2005 for rupees 1,80,000. Actual cost is 1,80,000. For the business owned property, we don't mind about the cost. We have to mind only the written down value as on 1/4/2021. So the sales value is 65,000, but the written value is 45,000. So 65 minus 45, but 20,000 will be the short term capital gain. Actually, sorry, in this some alignment issues. Okay, in the same pattern, exercise 8. So the listeners can practice exercise 8 and check it up the answers. Now the last part is there. We'll see in the next video. Okay, bye.